All right, let's get into some meat here. Jason, what are the core principles of your investment philosophy?
Well, I mean, preaching to the choir here. First off, it starts off with evidence, right? So, for my foundation, the foundation of everything should be what the evidence points to, which we know is pointing overwhelmingly to the fact that good luck on the active side, right? So, the default should start off with the passive option, right? So, the 100% pure broad-based index option. But then from there, I think it's only fair to ask ourselves, is there anything else that can be done? And if so, what's the trade-off, right? And that's where I think both of our affinity for factor-based investing comes from. There's academic evidence supporting that there is a kind of alternative way of indexing through these types of factors to try to capture some of that premium. And it can be done at a cost that does not make the premium evaporate. So it's a fair trade-off. So that's the second piece. Then I also layer on the potential to service clients in certain preferences, right? So we've had a lot of clients come to us about ESG investing or wanting to have their morality and their values reflected in their investing. And I respect that. I respect the desire. That's their freedom. It's their money. And what I will tell them is that, look, we can't delegate your values. We can't outsource to whatever you think is right with the universe. This just doesn't exist. No product of one exists. But what we can do is we can look at what the marketplace gives us and see what's possible. And there's in our practice, we do two different forms of it. The first is a broad-based kind of screening methodology and weighting methodology around ESG. And that's a combination of factor and index portfolios, index options. And then the last piece came out of some clients' very, very deep personal reasons for not wanting exposure to oil and gas. And the marketplace got to a point where we could do that again with passive and factor-based options. Now we do coach them around the deviation between the normal market returns, the further down the spectrum they go. But really, it's really about that. It starts with evidence. It's based on trade-offs, and it's also reflective of people's preferences around their moral issues. And that's really how we kind of cornerstone it all.
Hmm. Yep. Like you said, preaching to the choir. That all makes perfect sense to me. I do want to ask about ESG. Have you noticed, like, I don't know, maybe 5 years ago when that was sort of more of a trendy thing, we used to hear about it a lot. Not hearing a lot of questions about ESG these days.
Well, the term has become politically loaded in the U.S., as we know, right? And unfortunately, it's been targeted as being negative for any number of reasons. I don't look at it that way. I value democratic processes. I think democratic processes should also be reflected in your ability to spend your money. And there's no one should tell you how to invest your money based on your values, right? So full stop. Is there more demand for it? Look, we by default include a conversation. Well, every conversation we have with the client includes a question around it. And the reason for that is because first off, we want to make sure we're addressing it. We want to make sure that we're educating them. And if they express an interest, and it's really one question on our questionnaire that says, how important is it that environmental, social, and governance issues are taken into consideration in the management of your portfolio? Not at all. Paramount importance. I'd like to learn more. We have a conversation. We explain the realities. If it's important to them, they make a personal decision around that. But to answer your question in terms of new inbound, I haven't noticed a difference. Now, marketing wise, yeah, there's a difference. Inbound, not at all.
Yeah, but you're asking about it. That's interesting. It's part of your onboarding process.
Mm-hmm.
How do you approach arriving at an asset allocation with your clients, Jason?
So again, let's start with evidence, right? On the equity side, we're going to default to the market cap weighted global portfolio. And as we know, thanks to a lot of the stuff that some of the people who've been on your podcast have done, there is a actual quantifiable reason to have a home country bias, right? In terms of reduction of risk. Again, some of that comes from currency, but your guest did a better job than I ever will at that. So we will tilt that to approximately 1/3 of the equity portion. As for the fixed income side, similar approach, but looking at, again, kind of the factors and evidence around that, which is let's take a broad-based approach. Let's basically specifically target investment grade because the trade-offs on a high yield are just not, the risk return is just not what it should be. And duration around 5 years, which really is kind of a sweet spot for risk return based on what the academic research we've seen is. And basically, with the exception, of course, of when there's an inverted yield curve, and then you start piling up the cash. But effectively, you pick those two goalposts, the far ends, right? You got the stocks and bonds on one side, bonds on the other side, and you control for risk by exposure to each of them, right? So we come up with our default portfolios based off of that, but we also apply the same logic to the 4 different kind of model portfolios we do, which are again passive, factor, ESG, and impact.
How do you approach determining each client's risk profile?
So we take a very multidimensional approach to it, and one that's based, again, on a culmination of a number of academic pieces that are out there, right? So we start first and foremost in the initial meeting with the client. We start off talking about experience, talking about their experience with the industry, about their experience in investing, and understanding not just their level of sophistication, but looking for signs of a couple of parameters, specifically risk composure. How do they react in markets? Are they coming to me because markets are down, they're really annoyed by what's going on in their portfolio? Perception of risk. I think anyone who's worked in the industry knows that there's lots of misperception of this, right? People think, well, I'm in Apple because that's safe. Wait, no, that's like one single security in a volatile sector, and you feel it's safe, but that's not necessarily reality. And then preference, right? How much risk do they actually, as an investor, think that they want to take? So we look for those in conversation. And by the way, I'm going to take a step back. All of this is basically founded on work that we read in both Sean Brayman's paper for the OSC on risk methodologies, and also, which I think was a subsequent paper that was done by the CFA Institute on risk tolerance and risk methodology. So we start there. Then the questionnaire includes a risk tolerance questionnaire, and that is based on the old Phonometrica, now Morningstar questionnaire, which is like a gold standard in the industry. That gives us, between those two, all that data, when we're doing the financial plan, we pick the target allocation we think is the best fit for that. And in the financial plan, we then test for capacity based off their goals and throwing Monte Carlo analysis and see if they can absorb the market shocks. We also test for need. What rate of return do they need to earn? Because anything between tolerance and need is an acceptable portfolio that they can choose from. And then in the meetings, we test this. We show them basically the historical upside and downside of not just the portfolio we're looking at, but also other portfolios. And what we're doing there is we're testing for their we're validating that their tolerance or capacity is correct. We tell them what's there, but then we basically just see what their reaction is, and telling them, hey, okay, this is entirely possible that, worst case scenario's portfolio was negative 16% in 1 year. That's $160,000 on $1 million portfolio. They're going to have if they got a problem with that, they're going to have a visceral reaction at the moment that I say that. And that indicates that we're off, right? So it becomes a discussion around where they would be comfortable. And then the last and final and truest test of it all is composure. When things are going on in the market, good or bad, how are they reacting, right? Are they actually, especially when things go bad, are they calling me panicked? I will say, maybe it's a little bit glib, we get very few calls in market downturns. And I attribute that to all the work we do around planning and making sure that we're not exposing them more than they need to. And oftentimes the new ones will call me in the first downturn and say, well, things must be terrible. Okay, let's play a game. How much do you think you're down? Oh, the market's down 10. I must be close to that. You're down 4. Oh, so you're telling me not to worry about this? Yeah. And sure enough, sooner or later they learn.
And they're down 4, not because of active management or anything like that. They're down 4 because they're in an appropriate asset allocation.
That's it, right? Like there's the best way to prevent an error is to basically not put yourself in that situation in the first place, right? Exactly. And we meet plenty of advisors who think 100% equity fits everybody. I can deal with the emotional aspect of it. That's great until you can't, and then that client does the wrong thing, right? And that can be irreparably damaging.
Well put. Yeah. Okay, let's talk about what might be your favorite F word, fiduciary.
Yes.
Why is it important for investors to seek advice from a fiduciary?
Look, if you were to walk down the street and poll the average person and say, do you think your financial advisor has a legal obligation to act in your best interest at all times? I think most people are going to respond, yeah, or I sure as heck hope so, right? Because the reality is that we're holding ourselves out as people who are there to benefit them. And we should be held to that level of standard of care. So it's all about making sure that we as an industry are not only talking the talk, but walking the walk. And here's the other thing too. I'm a firm believer that the language around this and the understanding of the obligation will change behaviors. Knowing that you're a fiduciary, knowing that you have that obligation, that legal responsibility, that you're going to be held to account, I believe changes actions. And frankly, I think I see that anecdotally across borders when I talk to advisors in Canada, the US, or elsewhere. Higher standards seem to lead to better understanding of markets and planning, at least anecdotally, right? I can point to it leading to better outcomes for clients because it does. But in reality, that's I think the foundation of it. And I'll also say this much, there are certain organizations I won't call out who have literally fought this at every turn, fought the implementation of fiduciary responsibility at every turn. Why do you think that is, right? Why fight a obligation to do what's best for your clients? The only answer is that because it gets in the way of the thing you want to do for yourself.
Yep. There's academic research on that too, that when a fiduciary standard is imposed, the costs of products being recommended drop pretty significantly. I mean, it's a real thing.
Weird how that happens.
Yeah. Why do you think Canada has lagged behind the U.S. so much in the movement toward a sort of the fiduciary advice? Like I'm thinking about the RIA model in the States where they are fiduciaries. In Canada, that model's just, it's not at the same level.
So there's some cultural issues, there's some structural issues, and there's some luck. Okay, and I think we'll start with the U.S. There's luck around two things. First off, the Investment Advisors Act, which established the ability to become an RIA, which dates back to the late 1930s, basically entrenched within itself the fiduciary responsibility. So as the breakaway started to happen way back, these people were basically becoming fiduciary by nature of the registration, which I think started the entire dialogue and moved things along. You also have a greater history in case law and in other laws like ERISA that governs retirement plans in the U.S., where this has been an ongoing dialogue about degrees of obligation. So the law in the U.S. is more conducive towards basically imposing it on the industry based on registration. So that's your first piece, right? Your second piece comes into, now let's look at Canada and say, how is it different? Well, large financial institution domination, right? What does that lead to, right? Roll the clock back to the U.S. years ago, and the RIA market was not very big. The independent market was still growing, and you see a lot of the same shenanigans you see here. It's a lot of proprietary product, high price stuff, and so you have their profit line as being the primary driver of what gets distributed, right? So, do they want to be in a position where they're held to a higher legal obligation? Absolutely not. I mean, there's public statements made by heads of associations like lobbying on behalf of banks that say this outright. And the industry concentration is a problem because there's not enough competition in this country to drive and differentiate the need for people to say, no, we're going to step out and basically be the leaders in this, except for outliers like yourselves. I also like to say, sadly, Canadians have the worst case of Stockholm syndrome when it comes to banks I've ever seen in my life. They simultaneously love and hate them, and simultaneously are willing to pay exorbitant fees to them and just get gouged. And yes, but if you try to basically come in as a competitor, no, you don't have enough bank branches, like whatever else it is. The other piece of it is transparency. Embedded compensation is easier to hide, right? It's easy to pre-CRM2, where basically there was no disclosure of what the advisor was paid. There was plenty of people who basically the advisor just said, well, we're paid by the companies you invest in. Whatever nonsense. You guys have heard all of this, right? Then CRM2 happened, and suddenly the advisor's comp started showing up on statements. But that didn't change that much because it was part of the picture, only part of the picture. The other part was the embedded fees. So plenty of advisors, and I see this all the time when I'm in competition, oh, I only charge you 1%. Okay, but the MERs and the funds that, like, you're getting a 1% trail, the MERs and the funds are 1.4% on top of that, right? The number of times I've had clients, their jaws drop when they suddenly find out it's more than double what they thought they were paying, and they never disclose the account fees, everything else. So lack of transparency has been an issue. Now, this is changing as of Jan 1 with total cost reporting, where all of this is going to show up on statements. And classic Canadian advisor mentality, many of them have no idea this is coming, even though it's been announced for years. So guess what? Clients are going to start getting a rude awakening next year when they start seeing those fee numbers double. And then lastly, I'm going to blame Canada on a culture to some degree. Guys, you know what it's like in the US. These people are like born entrepreneurs. Like, I can't set foot in the US without having business opportunities thrown at me left, right, and center. They constantly want them to do business. Fantastic. I love that. Here, think about how much more lucrative the independent side is than working the bank channel. The bank channel will take 50% off the top, best case scenario. Best case. I've sat down with advisors, major books at major banks, and said, listen, you can leave with 2/3 of your practice, incorporate, make more money, get the lifetime capital gains exemption, get corporate tax treatment, all of this. And their eyes widen thinking about how much money they're going to make for doing and for having a smaller book. And they're like, why is everybody not doing this? And I said at the same time, let's see if you have the courage to do it in 6 months. We're just not, it's just lack of entrepreneurship in this country, whatever you want to say it is.
So let's keep going on. Keep going the U.S. versus Canadian comparison. And you talked to lots of people, Jason, all over the industry.
Yep.
What's your sense as to why Canada has lagged the U.S. so much on index fund adoption?
It's multidimensional, no pun intended. So let's start off with advisor education, right? This is one that I think is underappreciated. There were some changes back in the in the 90s around mutual fund sales practices, specifically around sponsorship of conferences by mutual fund companies, which that money is important to actually have these conferences held. And it limited the sponsorship to only events that had two-thirds mutual fund related content, which led to nothing but multi-decades of talking heads on stage talking about predicting the future. There's no room for practice management, for evidence, for everything else. So it crowds it out, right? So because of the over reliance on actual manufacturers to provide education, where are advisors getting exposure to this other than, God bless, your conduits, your channels, and other people we know else out there who are preaching the good word, right? So that's the first thing. The second piece is, again, it's easier to hide, right? Like, it's easier to hide what you're actually making under these things. Like, incentives drive actions. Fear of pushback on fees it makes it. If I can say I'm charging 1%, that's all they see, but they haven't looked at the MER. There's that. Basically the product sales focus of this industry in general. I think one of the things that led to, and I see it, we both see when we go to the US, there's this beautiful kind of reinforcing cycle in the US and the public consciousness of a greater understanding of what financial planning is, more people looking for it, more advisors specifically leading with planning, always talking about planning, right? The CFP has basically done, a board has done a great job of publicizing, and you've got this really serendipitous reinforcing circle going on to the point where you can even get undergraduate, graduate, and PhD degrees in financial planning. You can't do that in Canada, right? So they're so much further ahead on the business model because of, I'll credit the independent channel in particular. And one of the reasons that the independent channel, basically how they differentiate it, because think about it, you're competing with these big guys. How do you differentiate? Differentiate on cost and on service, right? So adoption of ETFs largely was basically one of the things pushed by independents as well. So you have that, and so that's a big issue. So the lack of independent channel in Canada is part of the issue, right? Because you think the banks want you selling ETFs? Okay, well, there's different tiers. The branches aren't going to do that because they want to make high revenue off of small dollar accounts. The mid-tier isn't going to do that because it's too lucrative, especially because they're paying salary to the advisors as opposed to what they pay at the brokerage level. And at the brokerage level, they want these guys focused on just selling, not planning. They got planning teams off in the corner, right? Doing the plans, but not actually implementing them. And so if you're there and investment is your primary means of value proposition, saying I'm going to do the market, I'm going to do average is not exactly a compelling argument. They're out there trying to beat the guy next to them. So there's just a lot of reasons. And again, I'll also say, just again, advisor education, incentives, structure, lack of independence, all of it feeds into itself.
Yeah, makes sense. Switching gears a little bit here, what is the most important role of the financial planner in a client's life?
I wish it was more uniform, but it's not, right? So it depends on the advisors, the planner's value proposition. But I think let's talk about what the end state, the best version of this industry is. The best version of a financial planner is one who basically sits across from another individual and asks them, what is it you want out of life? And let me help you get there. And is your advocate for basically progressing through life and the challenges that basically happen there, to put planning ahead of simple pursuit of wealth. Now, don't get me wrong, the pursuit of wealth is what gets us to be able to achieve the goals we have. But our mutual friend, Brian Portnoy, once coined the term funded contentment, right? Unless you figure out what's going to make you happy, unless you figure out what it is you want, the nonstop pursuit of wealth and more just never stops. The hedonistic adaptation, you just keep on moving up. So oftentimes, like, what's more important than a client saying, how much money can I make, or how much money what I flip on clients all the time is I say, listen, if I get you to live the life you want to live and leave behind the legacy you want to leave behind, does it matter what the return number was, as long as it was fair? They all stop and they're just like, you're right, it doesn't, right? So taking the focus away from the product, from the noise, and specifically getting the focus on what matters to them first and foremost, and guiding them through the actions that will basically help them succeed. That is what planning is at its best. And that basically, when you take that attitude of you're there to help them succeed in life, and I'm sure you guys have seen it. I know you guys do outstanding work. The zone for what you're going to involve yourself with, the things you're going to concern yourself with, increases. The value that you provide starts to exponentially increase because you're not focused on just, you're not focused on the next sale. You're focused on improving people's lives. So you keep on asking yourself that question, and your service offering expands to meet that need. So that is the best version. It's one who basically is going to expand their service to be as many things to a few people in a deep and powerful way to help them self-actualize the best version of their lives.
And what is the most common misconception you see about what a financial planner actually does?
I think it's twofold. I mean, the general populace thinks it's just about product sales, right? Like, I'm going to invest your money, right? Very few people understand what a financial plan is. And if you look at some of the surveys that come out, they're hilarious, right? There was one I think BMO did years ago, might be wrong who funded this one, but it was, they said that 50% of Canadians have financial plans. And I'm sitting there going, oh, right, sure. Yeah, right. And then when you dug into the numbers, a full 25% of them said it was in their head. Like, okay, sure.
Wow.
I've got a unicorn in my head. It doesn't mean I got a unicorn, right? And then you dug even deeper, and it was, when I actually investigated, some of them were quote unquote investment plans, written or unwritten. And I think the only data I've ever seen on how many, I think JD Power and Associates does a survey on this, and I think they pegged the number at like 7% of the Canadian population has a financial plan. I'm willing to bet it's half of that. Now that being said, the US number is closer to 15, I think. It was more than double. So we got a long way to go on educating people on what planning is. It's not about product. It's about life planning. It's about basically enabling what it is you want out of life. So that's the first thing. The second thing is this concept that the plan is a plan. It's a product. It's a noun, right? A document. Yeah, it is. The document's a snapshot, but that's just a snapshot. It doesn't mean anything unless you implement. And there is a saying that the honest ones around of us say it all the time. It's like, look, it's stale the day where it's written. Absolutely, because your life is going to change. Now, it's close enough to reality the day it's written and printed that we can move forward with that. But then over time, it needs to be constantly updated. It needs to be constantly updated as your life changes, as the situations change around you, as all this information is going to change. So it's not a noun, it's a verb, right? I like to call for things financial plans. I like to use the verb financial planning because that is exactly what we're doing. We are doing actions. We are not simply creating something.
Yeah, more of a process than a document.
It's a journey, not an end state.
All right, so you've got a podcast dedicated to fintech. What do you think are the most impactful ways that technology is changing financial planning?
Well, I mean, you're asking me this a couple of years after Gen AI come out. So artificial intelligence is changing financial planning, right? And it's changing every aspect of it. Now, the thing is that for the most part, most of the actual work that it's going to do is largely centered around productivity, right? It's going to be more geared towards how do I reduce the administrative burden or expedite the administrative burden and make things move faster. Right. That's going to benefit the entire community because the less overhead we have, the lower the price, the lower the entry level for clients, right? Because our costs, if they diminish, then we can offer the same level of service to an ever larger number of people or a lower price point, right? So that's great. Now, the counterpoint, the other aspect of this that's happening is that it's also helping with things like financial planning, right? Our friends over at Conquest Planning applied artificial intelligence in multiple forms pre-Gen AI to financial planning, and they created a tool that can produce a financial plan as good as any basic financial planner ever could very, very quickly, testing more variables than any human being has the time to. So, but I say that coyly because it lets basic financial plans get done quickly, but it lets really great financial planners accelerate their ability to a way they never could before. One of the guys there refers to as caddy for planning, right? It tells you what club to use next. It helps you make the decision, but it doesn't. But that's a quantitative output. You still got to bring the human aspects into it. But overall, it's allowing me to be more productive and more accurate and get more research done. I mean, just look at ChatGPT's research capabilities alone, right? The ability to geek out over something that Ben freaking posted on CSI, on Common Sense Investing, and say, is that right? Look at the papers, look at the counterpoints, and just do a deep research dive that were in 15 minutes. I get 10 pages dedicated to the thing. Like, my God. So my ability for learning, my ability for challenging more questions, my ability for research has increased substantially. My ability to produce the end takeaways, reports, whatever else it is doing that. My reduction of administration has done that. And the great thing about all this is it's taking away all the heavy lifting, all the heavy work that is involved with this, and really going to let me focus more on the actual client and the human being, and focus more on what is it beyond the numbers that's not letting this person succeed. right? How is it I can provide more value to this person, right? And expand that offering.
And what do you think are the wrong uses of AI in our world?
Putting private information into a public LLM with no good use case. I mean, like that's more no security. So security is the thing people have to be cognizant of. Like I don't put any client's information in these things. I go so far as to, I need to extract something from a document. Fine, I'm going to redact all of the personal information, but I'll extract whatever else I need. So I think there's really, it's too early right now, but there's already, I think Australia, last I looked, was already saying that, look, using ChatGPT with client information could be a violation of our privacy laws. We're going to hear a lot more about this. I think if anything, there's a lot of privacy law movement around the world, and it's going to continue on that trend, and AI is going to accelerate that. Also, I mean, reinforcing your own biases. As we know, the way you prompt an AI can deeply can change the answer, right? So I can go in and say, please tell me why dividend investing is the single greatest way to invest, blah, 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 blah. And it will reinforce that behavior as opposed to prompting it to say, I would like to see the academic literature regarding dividend investing and its validity, right? So it can be, to the tool, a tool in the hands of a craftsman can build something beautiful. A tool in the hands of someone who doesn't know what they're doing can build something dangerous, right? And that, unfortunately, because it's seen as validity, can reinforce false beliefs. And then of course we get into the entire, fake news issues that are a big problem.
Yeah. I was thinking about the same thing as you were talking about ChatGPT and AI, that I use it daily for research, but I find that if I didn't have a baseline level of knowledge and expertise on a lot of different topics, on the topics that I'm asking it about, there are a lot of cases where it'll tell me something that I know is wrong, but that it comes across very authoritatively.
Well, it sounds so right. Like, which is it is sitting in the quadrant of confidence and confidence and accuracy, but it could be the confidence and inaccuracy quadrant too. So yeah, it's funny because my first reaction when sitting down and playing with ChatGPT for the first time, so I was blown away. I took a deep breath and thought to myself, okay, this is interesting. I'm not too threatened by this, because what this has done is it's made the value of the person who can call BS on the AI significantly higher, right? Because at the end of the day, if the basic stuff can be done, if anything can be researched, the most important person in the room is the person who knows if it's true or not. So it doesn't eliminate my need for knowledge. It basically validates it's more important now, because everybody's going to be thinking these things if they're not careful. I'll tell you one of the other cool things I've been doing with AI lately too, in terms of research capabilities, is that your ability to build programs with this stuff is unprecedented. I may host a podcast on fintech, but I can't code to save my life. And I'm currently working on a case right now for my expert witness cases where I have to stress test with volatility a specific type of universal life policy. So I was trying to figure out how to build this in an Excel document, and I wrote out a page and a half of formulas. And I thought to myself, wait a sec, I can do a spreadsheet. Wrote a 2-paragraph explanation of what I wanted to build, took the formulas and the experimentation, put it into something called Replit, hit go. 10 minutes later, it had a version 1. And it looks pretty accurate. I got to finish stress testing it. But when you start thinking about all the things that, and Ben will get this too, when we're researching things, we say, okay, it'd be really cool if I could stress test this to the nth degree, if I can build something that does that. And I mean, you guys got Braden, you're lucky enough to have him be able to do that stuff. But for those of us who don't have a rocket scientist in our office, the reality is that now we're actually able to, potentially even test our theories and our research in a way we never could before.
Yep. Yeah, the coding aspect of it is really cool. Braden has tried using Replit specifically. And like you said, it's not a super fair comparison because Braden is literally a rocket scientist. He did not love using Replit. It didn't write code that he would write. A good friend of mine is he's a data engineer that's currently works for big tech companies, worked for a bunch of them. And we talk about this a lot as well. And he says something similar to what we were just talking about, where it gives us occasionally information that we know with our domain expertise is not perfect, but it comes across really authoritatively. It does that with code too, where it'll write code that, for you who otherwise couldn't code, it's still super useful. But for someone who's an expert in coding, it'll spit out code that an expert would never write.
100%, and sloppy code. I've had friends of mine review it, and they're like, "This is trash," but it's doing the job, right?
Right.
But the most important thing, and this is where people got to be careful. This is why one of the things I built into the screen was the most important thing is that you have to audit to make sure it's right.
Right.
I can't take it at face value that's right. So I've literally programmed auditing screens where I can see like every entry of every Monte Carlo to basically say, okay, like how did you arrive at this, and work backwards and validate. So if I can test that, I don't have to test every Monte Carlo instance over 1,000, but if I can do a couple of cases and then test a few of them and make sure it's all working right, pretty solid probability it's nailed it. If not, I can take correcting steps.
Yeah, but you have to be able to audit it. That's the interesting thing about it, is that it's super useful and it can help scale your time, but you still have to have knowledge and expertise to use it.
And there's the moral hazard, just like taking the answer straight from ChatGPT. Is if you take it straight from there and you don't know enough to call BS, if you just assume that the software you built is 100% accurate, you're in trouble. Also, I would say, like, be smart about it. What's the mission critical thing you're trying to build? Am I going to try to replace Salesforce with it? Absolutely not. A portfolio management software with it? Not even close. But, testing Monte Carlo on a universal life policy? Sure.
Right. Yeah. Yeah. And you can audit the results.
Exactly.
Relatively easily.
Exactly.
Yeah, that's good. Okay. So on the topic of technology, we have a ton of our client relationships that are 100% remote at this point, where we never meet the client or rarely meet the client in person. What should advisors do to maintain strong personal relationships with clients in a primarily digital relationship?
So this is something I've been talking about quite a lot. It's a concept of digital intimacy. It was a term it sounds weird, but I coined with my friends Adam Holt and Derek Notman on their podcast. And I was basically saying, look, digital experience and client intimacy are not things that are separate. You can use one to augment the other. And what you really need is to think about digital intimacy. How do we create client intimacy over digital means, right? So most of my meetings, the vast majority of them are over Zoom. Now, the great thing about it is that that's a new medium. It's a new medium that when I'm facing you face to face, I can't put something up the same way between us that I would in person. And unfortunately, for most of us, we've failed to listen to Marshall McLuhan and the medium being the message, and we've tried to apply the old medium to the new message. And what I mean by that is, great, we got to talk to a client. Let me pull up a PDF of their statement, right? I'm taking digital representations of paper and sharing that. You know what's better than that? A lot of these softwares that we are using day to day now, whether they be portfolio management softwares, financial planning softwares, some of the insurance illustration softwares out there, they are built almost with a consumer mindset in terms of how they're designed. And because of that, there's plenty of times now where I don't even open up the statement. What I'll do is I'll actually open up their portfolio in my portfolio management system, and I'll kind of walk them through a narrative through some screens, and I'll be able to have an interactive conversation with them, right? Another one of my favorite ways to use my financial planning software is Conquest, where I'll turn off all the recommendations, and then one by one, I'll turn them on, and they'll see the animation of all the red bars turning to green, and they can stop and ask questions, right? Well, wait a sec. Why would I start CPP at age 70? Why wouldn't I start it now? Because I can take it now. Great question. Let me show you what happens. Slide, boom. They see it immediately. So they basically are not only being able to challenge you, but we are able to respond and get validation to an understanding around the recommendation, right? And the great thing is that they can, again, what they're doing is they're taking over part of the journey. Whereas before with the slide deck, right, I have 10 slides. We can go through 10 slides on this journey. You want me to deviate? I don't have an extra slide here. But you want me to deviate and talk about, you specifically, okay, I'll stop talking about your retirement and I'll focus on that big trip you have coming up and you want to finance for a year off. Okay, great. Let's go over there. This is how we're going to fund it. It allows them to be a participant in the journey. So what I'm saying is that when I'm talking about this, I say, look at your softwares that are out there, right? Look at how they can be used in engagement. Many of them can already. When you're looking at onboarding new things or finding tools that are valuable, can they actually produce something that can be put in front of a client? And more importantly, when I actually consult with technology companies regarding what they're building, I'm telling them to start thinking this way. It's like, don't make me open up a PDF. Give me something dynamic and interactive that I can even send to the client. They can have a dynamic and interactive experience with. Let's embrace the medium more, right? And we're still, very early in our thinking around this. I mean, I'm thinking about it. I'm not sure how many people are really, but it makes for so much more of an entertaining experience, but also, and I showed this once to Megan Lurs. I'm not sure if she's been on your podcast before, but well-known behavioral finance expert. And she basically said that I kind of stumbled into the trans-theoretical model of change. I had basically, through doing this kind of validation, showing explanation thing, and basically letting them challenge it, I was hitting 2 or 3 steps of this model that allows people to accept change and accept what they're being told, versus being given a checklist and saying, here it is, this is the end result, trust me. They're actually going to be able to see it.
Yep. Yeah, we were doing we called it just interactive planning, but same kind of idea in office before things went super remote. And we still do it now. But yeah, people are blown away by going through the whole financial planning process. And like you said, seeing how the outputs change as you change different inputs. I think it's the only way to do it, in my opinion.
Well, I think that having a plan is empowering to a client, a plan they can understand. But I think that sort of interactive understanding that helps them understand what it is and why and where the variations are is education, and it's incredibly empowering. I've had people who felt overwhelmed by the initial presentation saying, well, not really getting how this works. I said, okay, let me try it this way. And I show them in the interactive way, like, oh my God, I get exactly where you're coming from. And they feel so empowered and excited and happy about it, right? And really, how are they going to listen to us unless they actually buy in, right? So anything that helps build that understanding is powerful and can really move the needle for them.
You know what? I think it was Eilert Fishbach, who's a past guest who studies motivation. I'm hopefully not misquoting, but I'm pretty sure she talked about how when someone participates in arriving at something like the amount that they need to save, they'll be much more motivated to actually stick to it. So that makes a lot of sense from that perspective too.
Absolutely. And the thing is that you can literally modify on the fly with some of these softwares now. Like we've had times where clients are like, wait a minute, I told you I had 1,500 per month. Okay, maybe it's more like 1,200. No problem. Let me modify this now. Let's see where this ends up and see if that's material or not, right? And then lo and behold, like, so you're creating so many different points of buy-in and communication, or they can turn around and say, like, listen, what if I spent more every year? Because maybe I'm not comfortable. And my question becomes, well, do you feel like you should be spending more, the things you're not doing? Like, yeah, I'd like to go and do whatever. Okay, great, let's do that. And show them the net impact and let them make an informed decision.
Yeah. So you're talking about planning, Jason. Let's go back to basics. And can you talk about what a high quality financial plan covers?
Yeah. So, I mean, I'm a big believer in keeping this simple. I do a lot of complex planning, but at the end of the day, I like to say it's a process of distillation, right? All the super, brainy, nerdy things we do up here with numbers get distilled down to a financial plan that gets distilled down to a 10-page or 10-slide presentation is the way I look at it. I want people to take in the keystrokes in 10 minutes because their attention starts to drop off pretty heavily after 10 minutes to listen to someone. So you want to be clear. But then you want to have the validation piece, which is the actual plan itself, besides the presentation, right? And that really, I have never been a fan of this concept of this 100-page plan that used to go around for so long, where it was just like, here's everything, and I'm showing you why you pay me to do this. And it's like, to me, there's something so insecure about not being able to speak simply, right? So what goes into it? To me, I'm like, keep this simple. Who am I doing this for? Who's the profile page of the people involved? What are their goals and objectives in life? What's their balance sheet? That's their starting point. What's their income statement? Like, where's the money coming from and going to? How's that changing? What's their asset allocation and return assumptions that we're making here, right? Because that's what's going to go forward. What does the projection look like, right? Where's the bar graph that shows them how they're going to do? Where's the stress test that shows them that they're going to be okay, even if something goes wrong? And then what are the recommendations on how they achieve it? And then you want to put, and then an appendix. And frankly, what I just mentioned there should be less than 10 pages before you get to the appendix. The meat of, like, you want to hand someone a big 30-page plan, that's fine. But I've done that. Like, our plans were basically kept down to about 20-ish. I would say, look, don't be overwhelmed by this. It's between these 5 leaves of paper that everything is explained. People are relieved. Now, the appendix, of course, there's some people who want to go deeper, so I would keep it down to like cash flow sheets and asset projections and leave it at that. And I always jokingly at the end of our presentation have a picture of a stack of files and say, okay, this is my coy way of saying that if you want the 200-page plan, I'll give it to you, but you're going to live to regret it. And I'll tell you, maybe 5 times in my career, people are like, okay, I'm not understanding this fully. Like, give me everything. And then they turn around and say, okay, I now know what you're saying. Can we go over the spreadsheet in the back? Yes, we can. Right. So I think sometimes people just want to feel like they're getting value for money. But, anyone who's been to a buffet trying to get value for money knows they leave not feeling not so good. So.